You guys are getting paid pretty well right now. The question is there a danger that you're actually being underpaid rather than overpaid, and the risk is much greater than we all think?
Well, the brilliant Henry Kravitz was wrong maybe a couple times in life. That's one of them. He's done a pretty good job in making his calls. Having said that, he was wrong about that because we saw what happened next in 08, 09. So where I disagree with that quote about being a good time, you know, and what was just said, you know, look, we're seeing credit metrics deteriorate, and we're seeing it in the fact that there are more downgrades than upgrades by a factor of more than 2 to 1, and we believe in our models and our analysis that number is going to 3 or 4 to 1, downgrades to upgrades among high yield cohorts, number one. Number two, default rates, which were basically non-existent a year ago and 2 years ago, are rising, and we believe the cumulative default rate will get to 10%. And so we think that there's going to be a big distress cycle coming, and a lot of the metrics that I think was just referred to are maybe slightly different than the vantage point that we're seeing, because we see a worsening credit cycle. And so what makes this the golden era of credit is very different. We'll see a 10% default rate before this is all done with, but we'll see 90% of the credits, therefore, not default. And if you're good at picking credits, good at building a portfolio of performing credits on the liquid side and making loans that have tight covenants, that have good credit metrics on good companies that will make it through, then you'll make the best returns we'll see in a generation. And so making a double-digit return on your private loans when the banks aren't lending is a beautiful thing to be doing. In addition to that, on the liquid credit side, between high-yield leverage loans, structured credit, the various credit metrics that you can look at and credit segments that you can look at, we're making the highest rates of return in terms of both the coupon and cash flow, as well as what we think is going to be the ultimate IRR for those assets.